a good evening and a welcome to all those who have joined this webinar. This is a part of our series of the ETF Pathshaala, which we have kickstarted, and there have been quite a few discussions we've been having on the passive space. But we decided that this month we'll have an interesting discussion, the correlation and maybe the compatibility of the active and the passive space. I think there's always a debate between what is good, whether it's active or whether it's passive. We've always maintained that it's both strategy. I think that's the discussion that today we are going to be having, and we will talk a little about the basics. We will talk a little about more in terms of more products that are there in the market on either side and how each of them are synchronized to form a good portfolio for people who are planning their financial goals. So the concept today that we are discussing and the theme of this webinar is the balancing act, active and passive investing in harmony. We are going to demystify some of the debates that are around active and passive. We goals the diversification and innovation through both these strategies and what Saket, who is from ETF Junction. So with these speakers, I think we do need not go into further introduction. And let's start the webinar. Starting with you, Saket, let's put some background into this space and try and understand what is one, of course, this active passive debate that's going on with at the backdrop of a growing both passive and active market, and why is it so important for investors to understand the distinction between active and passive?
Thank you, Koel. See, in the recent year, what we have seen that the Indian financial market have witnessed a remarkable coexistence, especially between active and passive strategies, right? If you look at active investing, refers to the strategy where investor either individually or with a fund manager, right, manages their portfolio actively, select or do research and manage the stocks or any other assets which is there with the aim of outperforming the market. That's where the aim of active is. Contrary to that, in passives, on the other hand, involves investing in an index, right, or a benchmark, whatever it is. It could be index fund, it could be ETF, right, that seeks to replicate the performance of a specific benchmark index or somewhat similar, something like Nifty or Sensex. Now, when we look at the fundamental difference, right, which is there between these two investing approaches or strategies, is largely from investment management perspective one, second cost, and third is performance, right? Now, in investment management, the idea is that, the fund manager obviously continues to deliver, right, over and above, right, the benchmark. So that is where in passive, it just mimics, takes a decision, right, and largely mirror the index for the benchmark, right? Second, they just for the larger, person who are part of the panel, part of the entire discussion which we are having, there is a cost which is pretty critical at this juncture when there's a debate happening, especially across the globe, that active strategies often come with a high management fees because there's a trading cost, taxes, frequent buying and selling, right? These expenses can erode the return over a period of time, and that's what is now being clearly looked at. Whereas in passives, investment tends to have lower expense ratios, because the set and forget approach, the customer, saves relatively more over a period of time as far as the management of the fund is concerned. Third, clearly, in the third category of performance, when we look at the intent of the active fund managers to beat the benchmark, deliver better return, right, outsmart indices, whereas the passives basically look forward to continue and ape the performance. So there's no extra return he's looking forward to, right? Now, when you the important point which you are looking forward is that important investor for this to understand the distinction. Why should they really look forward to understand the distinction? Is clearly that investors across the spectrum has a different objective. Now, these two have a different objective, and clearly, whatever suits an investor, you should be looking forward to that. Seeking a potential higher return or willingness to take more risk, he should look forward to an active. Whereas someone who is looking to just diversify and have a stable return, he should look forward to a passive investing. That's one. Second, someone who has got higher risk tolerance, he should definitely look forward to the active. Someone who has got lesser risk tolerance, right, should look forward to the more diversified and passive strategy. Third, obviously, the cost consideration, which I just stated. And fourth, the when you investors look forward to it, it's all about market efficiency. Not all spectrum of market or in different geographies, the efficiency is same, right? Whenever there is a higher efficiency, passive strategies definitely deliver better and they are preferable one, right? Lastly, right, from the portfolio diversification, right, it is imperative that investors should create a portfolio which has both best of the both world, right? So if you look at in conclusion, both active and passive investing have their merits, and choices should depend on the individual's objectives they have to achieve, preferences. They can use both strategy in combination to deliver and get a better return.
Thanks, thanks. I think that was a very, very detailed description of the active passive with its pros and cons. Coming to you, Prateek, what is your view on this entire active passive debate? You've seen the landscape evolve over the last few years, and you've also come across a lot of misconceptions that people have regarding active and passive, and how can what has your guidance been to investors to avoid all these avoid the debate and focus on getting a good balanced portfolio?
Yeah. Thanks, Cole. Thanks, Saket, for having me out here. A very good initiative overall, and I think hopefully you'll be able to do this for a very long time. So I really like the topic of today's conversation. Normally I've spoken at a lot of conferences where always the topic is active versus. This is one of the first ones where the topic is active and I think that's excellent. That's how it should be. To be honest, there's just so much debate, but honestly, I don't think this is in the US. There is similar debates between active and versus passive. There's normally active and passive. Ideally, what we've seen is that a lot of investors are sort of flocked towards passive over the last 4 to 5 years because the return differential has come down dramatically from where it was 10 years ago. So today, I think both the sort of styles of investing are giving you pretty much good returns. Obviously, if investors are able to find the right funds which will outperform, that's good. But I think the idea behind passive funds is simplicity. We in fact at Motilal Oswal did a survey, and the biggest reason to why, and this is with 3,000 investors who invest in passive funds, and they say that the biggest reason to why they're flocking to passive funds is actually simplicity. When today's world, when you have to choose between thousands of funds out there, if choosing between say 500, say 30, 40 mid cap funds, selecting a simple mid cap index fund or a mid cap ETF really makes life easy for a lot of investors. So I really think that if you look at also portfolios outside of India, most people actually have a combination of active and passive in their portfolio. If active one or passive one, you'll have investors either holding only active or only passive, but it's always a combination. What I think really works is really to have them together. And the reason why I would say you should have them together is because when it comes to passive investing, there is not really a need for you to ever sell your portfolio or churn your portfolio or buy something else. You're basically, your returns are pretty much in line with the index. So, you can hold on to those investments for 5, 10, 15, 20 years without really worrying about, how they will do in the future. So that's one of the biggest attributes of passive. Today, an average 25-year-old or 30-year-old is looking to invest. They're looking to invest for 30, 25, 30 years. A passive fund really makes it easy for you to select the right fund for the next 30 years. But I also believe that a lot of investors are also looking at how do I optimize my portfolio for the next 3 to 5 years time. So then obviously it makes sense to sort of invest in a good actively managed fund where you think the fund manager has the ability or a capability of outperforming the index. So I think a combination is great. We keep telling investors is have a allocation towards passive. Today the allocation to passive is close to zero, maybe 10% for most investors. We believe that allocation should probably go up over time, and a healthy balance of active and passive, it really works well for your portfolios.
That's always the balance is always that we have spoken about, and also what we've always propagated in terms of core satellite balance. Moving over to you, Aman, you have been in this industry for a long time, have been with creating indices and seeing the index investing market grow out. What in your views is, of course, the active passive debate that you have seen in view with the kind of conversations that you have when you are kind of looking at new product development? And what are the new demands that you're seeing both in the active and passive space, and how are they differentiated?
Sure. Thank you, Koel, Saket, for having me. Good evening, everyone, and good morning, good afternoon to people around the world. Again, very heartening to see that we're discussing a topic which is a balancing act between active and passive, and not really the cliche active versus passive, which is going on elsewhere. So we've evolved to a stage where at least we've started believing that it's active and passive, and not really active versus passive. It's also heartening to see that passive as a concept has now grown. So now we have a number to put to passive out of the overall asset size. 7.42 trillion as of September end, as against 46 trillion. So we're already around 16-17% of the overall managed asset in India. Globally, this number is around 37%. US is around almost half now, 45 to 50%. So it's good that we're moving in the direction where passive is now, starting to be a dominant share of the industry. I want to believe that it's also bottom up for everyone, for an average investor to have at least 70% of its allocation towards passive to replicate the industry profile. Now, 6 years ago, this number used to be 3%. So, a 3% market share going to 17% is really heartening. And also good because I've been a part of this. And, for people who are passionate about passive, this number is encouraging. Clearly, from an index provider's point of view, we look at it from a different perspective because we work with almost all AMCs along with them to create innovative indices so that, ETFs and index funds can be created. Two trends that I've observed over the last 1 year as compared to the previous 5 years in the passive space is one is that maybe until last year, people were experimenting on passive products in the large cap space. And again, there have been empirical studies to say that, large cap space is informationally more efficient. And that's why, for an active guy to consistently outperform in the large cap space is difficult because, there are well-researched stocks, 100 analysts looking at each stock. So, it's really difficult for anyone to know anything that others don't know. So the market becomes more informationally efficient, and outperforming consistently becomes increasingly more difficult. And till last year, the observation was there are more and more passive products in the large cap space. And the belief was that mid cap and small cap, there's alpha left for active fund managers. And that's why you should allocate more of your money towards active funds, at least in the mid cap and small cap space. But this year, what at least my observation has been that with passive products, ETFs and index funds, also in the mid cap and the small cap space. So, in the segment spectrum, we've come down to cap 250, there's one product this year. Micro cap 250, there's one product. Large mid, there's one product. Nifty 500, there's one product. So broad observation is, I hope my internet is stable. Broad observation is that there are more and more products incrementally around the mid cap, small cap, or large mid small, which is again encouraging because now the efficiency that we talk about, the informational efficiency that we talk about, is maybe trickling down to mid cap and small cap also, so that this concept becomes more broad based. That's trend number one. Trend number two is that asset managers are now also experimenting with alternative index strategies beyond a Nifty 50 or a Nifty 100 or a mid cap 150 or a small cap 250, which is of course a plain vanilla beta exposure to the market. We've increasingly observed that people are, asset managers are now launching products which are either sector or theme or strategy. So within sector this year, we observed 3 products on IT, already Nifty IT index, one product on financial services, ex-bank, one on housing, one on bank, one on PSU bank, another on private bank. So the acceptance of passive product within the sectoral space maybe has increased this year. Interestingly, factor-based indices, and again, maybe we'll talk about factor-based in more detail, but Nifty 500 Value 50, one product on, I think one product is filed on mid-cap 150, Momentum 50, which is, the momentum strategy within the mid-cap space. So increasingly, the encouraging trend is that passive experimentation within the mid-cap and small-cap space, and taking sectoral calls, not just through active strategy, but through passive strategy.
Yeah, I mean, I agree. There have been a plethora of options, and with those options, obviously within the passive space, and then you have a whole lot of options within the active space. Prateek, you being an asset manager which has both options, and with you have a variety of investors, both very well equipped to understand all the different options, some who are still figuring it out, some who are absolutely brand new. So with that kind of a varied investor base, how do you go and kind of create that kind of knowledge and awareness for each investor segment, and accordingly provide for such investors in terms of all the options within it? And obviously, because what you are trying to offer to all the investors is a way that they can meet their financial goals. Now within, like Aman said, we have, which are market-based return products. These market-based return products are both in the active and the passive space. You have, sectoral products, both in the active and the passive space. So how confusing would it be for investors, since you are engaging with them, to manage to pick from both and create a proper hybrid portfolio?
Yeah, so that's a great question. I think one thing that we as manufacturers keep on getting feedback from our retail investors is how much we confuse them all the time. So we launch more and more products, more and more schemes. Today, so at Motila, at MO, we have about 30 passive schemes, which is a huge number. And I think we made a huge mistake in the past of talking about all 30 products. And I think what we do today is, in fact, we made a mistake of also trying to sell complex products also. So I remember a year and a half ago, we were trying to do a lot of, I think customer education, investor education on factor-based funds. So smart beta strategy funds. And that really, and honestly, was not a great not a great idea, and also not. I mean, it was done well, but we didn't get any sort of traction there. So I think what we've realized is to stick to simple funds. Today we run 30 funds, but we talk about only say Nifty 500 fund, which we are most positive and optimistic about. It's the fund that we think will probably do the best in investor portfolios, especially retail investors. So that's one. So I think if you look at our customer education towards retail investors, it's very simple. But again, I think as an AMC, we cater to very large or different types of investors. So I think if and a lot of the sales in this industry happens B2B. Most of the industry, I would say, approximately 70 to 80% of the industry still is very advisor-led, advisor-friendly. So I think we basically have a very sort of sophisticated sales team, and we tend to pick and choose which products to talk about, which products to sort of I think really put education on, depending on what sort of customer segments we talk to. So I think that's one thing that we've learned, and now we're doing a very good job of that. But yes, I think combining an active and passive is something which I'll tell you what we've done. We used to have two separate sales teams last year. So we used to have a passive sales team, and we had an active sales team. The active sales used to sell active, the passive sales used to sell passive. So now, we really think that both need to be in everyone's portfolio. So in fact, what we've done is just combine the sales team. So we have MOMC as one sales team that does, I think education, awareness on both type of products. And I think it's really ended up really well, because, both get to, work with each other. I think, you have customers who like passive funds, we get to talk about active funds, and vice versa. So I think overall what we've seen is that I think it really works to go out there and really talk about asset allocation, with our partners. And I think we've seen that this has actually, really helped. Passive 3 years ago was primarily direct. So it used to have come from institution, family offices, digital platforms. Today, it's a lot more broad-based. So there is a very wider acceptance of passive funds happening across all sort of, our partners. So we believe that this sort of, single-headed approach of trying to make sure that all investors, all our partners are aware and are able to adopt it is I think works very well. And also keeping it simple, I think if you look at Vanguard also, they talked about total market fund or the S&P 500 fund, but they have hundreds of funds out there. So I think most of the funds are very customer led, whereas as an AMC, we'll only sort of promote 1 or 2 funds.
Yeah, and I think that makes a lot of sense in, kind of putting teams together and having that one conversation when the investor, is kind of being addressed on the financial goals, because that's the idea, that both form a part of your portfolio. And Aman, you were talking a little earlier about, smart beta. While a lot of people out there in the market right now that I'm having conversations, smart beta also may be a very, very confusing term. Factor may be a lot of confusing term. So concepts like this are always, obviously, the active side of the options were always there, who used to give these kind of products in the active space. And now passive has started giving, because people wanted something, market return plus. That started the kind of growth of factor based. So how are you seeing the conversations and the interest around smart beta factor based products, both in the active and the passive space?
Sure. Maybe before that, I'll add to what Pratik mentioned on, the number of passive products available, and you, Koel, also asked whether it's confusing the market. Is it too much for the market? My take on that is, honestly speaking, we don't know how much is too much. So where do we stop, or at what point do we believe that it's too much? So, for example, in India, there are 350 odd passive products today, 352 to be precise, both index funds and ETFs put together. In US alone, there's 3,000 plus ETFs. One perspective is that there are around 2,500 stocks in US. So there are more ETFs than stocks in the US. Globally, there are more than 10,000 ETFs traded. In India, we only have 350, and there are 2,000 stocks listed on the NSE. So if you look at it from that perspective, maybe it's not enough. But maybe for a country like India, where the MF penetration is itself is not very high, then maybe we can say that maybe 350 products are too much. But another perspective to look at the same thing could be, for example, these 350 odd equity products. 250 odd are equity, 100 odd is debt. So if I look at 250 odd equity product, they are only based on 56 unique index strategies. So when I choose a passive product, I would want to look at an index first. So for example, Nifty 50. Nifty 50 itself has 36 products around it, 18 ETFs, 18 index funds. So now, do I count 250 as 250, or should I count them as only 56? Because there are only 56 unique index strategies around which there are 250 products. So my decision making becomes simpler because now I don't have to choose between 250 equity products. I have to choose first between 56 index strategies. And once I've chosen Nifty 50 in my mind, now I have choice between an index fund or an ETF, an AMC. And of course, you should look at tracking error. You should look at lower the cost. You should look at liquidity around the ETF and things like that. So decision making becomes simpler if we look at it from a perspective of an index. And if you look at it from a perspective of index, then it's not too much. Now coming to your question of smart beta or factor-based index strategies. And maybe, if I can build a background first, that in terms of what is a dumb beta or what is a plain vanilla beta before we go to smart beta. So, a plain vanilla beta is basically getting returns similar to a market benchmark. For example, Nifty 50. a traditional index strategy of buying 50 blue chip companies of India, called as Nifty 50. If I get returns similar to that, it's a plain vanilla beta. Any strategy which is trying to be smarter than this dumb beta by maybe changing the stock selection criteria or changing the stock allocation criteria or the weight allocation criteria is a smart beta or an alternative beta strategy. Now, the simplest of that could be that while I buy the Nifty 50 stocks, instead of allocating weights based on free float market cap, I can have an equal weight strategy. So globally and in India, the simplest smart beta strategy is a Nifty 50 equal weight, for example, because I've kind of deviated from a traditional free float weight strategy. Then other degrees of smartness in beta could be by changing the stock selection criteria, and this is where factor kicks in. A factor is nothing but a common thread of selecting stocks based on certain rules. For example, someone may like value stocks. Now, value could be subjective in the eye of the investor, or if I'm trying, if I'm successful at building certain rules to identify value stocks. For example, lower price to earnings, lower price to book value, lower price to sales, lower price to cash flow, higher dividend yield. And if I build a formula or an equation to select stocks which are all of these on a quantitative method, then I have a value portfolio in front of me. So Nifty 100 value 30, for example. 50, for example. Select the 50 more companies out of Nifty 50. There's one of that strategy recently launched by one of the AMCs. Other strategies could be around quality, for example. So I believe in quality companies. I want to buy companies with high ROE, low leverage, high stability in earnings growth. I build an equation around it, quantitatively select, let's say, 30 companies out of top 100. That's Nifty 100 quality 30 for you, for example. So these are smart beta index strategies where instead of plain vanilla Nifty 50 allocation based on free float, I'm selecting stocks based on a factor that is, it could be value, it could be low volatility, it could be high momentum, it could be growth, it could be dividend. So if I like a factor, smart beta, I would place smart beta somewhere between pure passive and pure active. It's a quantitative way. I hope my internet is stable. It's a quantitative way of trying to do something different from pure passive. Globally, smart beta strategy is already more than $1 trillion US dollar out of around 10 trillion of total passive AUM. So it's emerging, it's growing. In India, I would say it's around 9,000 crore plus segment. And people are again experimenting with these factor strategies. This year, FY24, four smart beta products have already been launched by 4 different AMCs.
Yeah, and I think there have been a large number of new products that are coming along. And I agree with you, Aman. There are, like you said, 56 strategies, but I've been of late conversing with a lot of the retail customers. I think within this webinar, we could say very, very highly financially literate, but there are a lot of, investors out there, base retail plus people who are even in organizations who are still figuring out the basics. So, that actually leads me to the next question, Saket. And you have also been, we've been seeing a lot of the retail investor behavior. We have been meeting slightly informed investors as well. What are you seeing, in terms of the emerging behaviors in terms of investor choices? How are they choosing between active and passive, and how is their choice getting affected by the plethora of options that are available today?
Thanks, Koel. If you look at the current investor behavior, it's very fascinating of dynamism driven by various factors. And a couple of them to note what is that there's a combination of active and passive. Let me take you through the recent data. I think if you look at the September data, which is available, it has been a fabulous growth for industry. It's not, I would say, secret, roughly around 16% annualized growth, which the industry has seen in last 5 years, right? And a 20% CAGR in last 10 years, from roughly approximately a lakh crore to 47 now, from 2000, roughly around 1.02 lakh crore. Now, if you look at the equity which dominates, right? If you in this entire category is roughly around 60% of the 47 lakh crore. What is important to be seen in that last 4 years, the tide has started really changing fast, right? From a 7% AUM of roughly around 1.7 lakh crore in 2019 September to this September, roughly 17%, approximately 8 lakh crore in September 2023. That clearly speaks that, where things are moving, and it's pretty fast as we see globally, right? In a couple of other countries like Mexico, Indonesia, their things have really been pretty fast. Second, and again, if you look at the breakup between institutional and individual investors, right, it is 60% individual. If I just do a dichotomy of the assets of Indian mutual fund, and 40% is institutional investors, right? It is important to see that in the ETF and FOF category, which I think Aman also stressed, it is 90% institutional, but 10% is individual. That's not a small number. If you look at institutional is having a lot of provident fund and pension funds, it's a good signal and in a good kind of direction it is moving into. Come to the third observation, right? That's again very important. If you look at the category-wise, breakup between for the ETF and FOF category, 72% assets are from the direct category and 28% from distributor segment. That's again pretty healthy that even distributor segment is looking forward to distributing passives, right? Which is beyond what we were generally expecting and looking at. Fourth, and the last important point to look at that, if you look at from direct and distributor, if you break up the entire AUM, total direct is 45% and distributor is 55%. Why 45? Because largely institutional investors are direct, right? Now, among the direct 45%, direct institutional is 31%, and direct individual investors are 14%, which is 1% higher than last 1 year. Clearly, it is showing certain trends, right? And this is in that direction that all of a sudden in 4 years things have doubled up, or it has moved to roughly 8 lakh crore. The balance between active and passive investing interest is completely intriguing. Traditionally, active has been a dominant force because it all started in 1964. It's a lot of emphasis and stress was there, but reflecting the quest for alpha was there, belief in skills of fund manager. However, the winds of change are blowing as passives investing is steadily gaining ground, right? As we can see, the shift is attributed to the recognition, obviously, of the merits which it brings to it, which is the low cost, simplicity, as Prateek also stressed, ability to capture broader market, trend efficiently. And as India is stressing and moving towards a little more efficient market, I think rightly Aman again stressed that it is not only large cap, it's a mid and small cap also seems to be, getting the slot in the lot of comparison and under performance against the benchmark. So that is when, so what makes this blend so captivating is that investors are increasingly recognizing the potential of both asset, strategies, both, I think, investment strategies. They're adopting more nuanced perspective, understanding that active and passive strategies are not completely exclusive to each other, right? They could jointly be taken in the portfolio and they can do a better job. So many more of them are incorporating a hybrid strategy, right? Using best of both the worlds, right, for better return. So that is where we are looking the trend moving to. Thanks, Koel.
Yeah, I'll stay with you, Saket. You are kind of mentioning the winds of change and how people are moving towards passive. The fact still remains that passive today is kind of roughly around still 17% of the mutual fund industry, which also is a asset space that's still growing out and needs to grow out even more compared to the entire scope of investments that India has. Now, given that, then what do you see are the challenges that today investors are facing in terms of accessing these challenges, getting information to these different kind of vehicles, and how can investors stay abreast of all these things that are happening around them, and how can they stay more informed so that they can make a much more kind of a proper decision rather towards taking that financial plan to meet their financial goal?
Great. That's a very good question. See, as Pratik also stressed that it was largely perceived that the passives are not a sales push product. India largely has been a push market, right? If you look at whatever distribution of the financial product has been largely on a push side, right? Whereas, passives obviously were interest of the investors, their education takes the hallmark, right? So if you look at clearly, couple of them are that, continuously learning, stay, and as I say, the fast-paced and the dynamic world of finance, right? Adaptability is the name of the game. This is where very, very important that the world is changing. It is not the same world where you fill it, start it, forget about it, fixed deposits, right? Here things are very, very dynamic. And that's where investors have to move up the curve in terms of continuous learning. And that's stay hungry for knowledge. The financial markets in perpetual state of evolution. They have been changing almost every day. And reading books, attending webinars, following reliable financial news sources. There are a lot of common platform which really gives you a lot of financial literacy. That's number one. Second, clearly, the age-old adage of putting all your egg in one basket is even relevant much more today. That's where it's very relevant that you have to ensure that you diversify across different asset classes, industries, geographies, and also marketing strategies. That's pretty critical. Third, obviously, one has to have a long-term perspective in investing. That also goes for passive and active, but here passive it is much more that you just stick to it and it will deliver. I think so. That's where coming again is that emotional discipline. That's pretty critical. I think a lot of investors who came in Indian market post COVID, because that's where the numbers really flared up. They have not seen the downturn of the investing or the downturn of the market. That's where the emotional has to be taken in the back and clearly understand that, create a rational, predefined investment strategy and stick to it. That's pretty important, irrespective of the market sentiment. Last and most important, however may you add knowledge to it's if you're uncertain about your investment strategy or evolving market landscape, considering a good financial advisor. Now, their expertise can be invaluable in navigating the complex market condition which we are getting into every day. Well, we can't hear you. I think you are.
Yeah. Thanks, Saket. That was quite a very, very detailed way to kind of give a guidance to the investor. Keeping in line with the guidance to investors, Pratik, I'll take over to you. Given that there are so many choices, that it can be pretty confusing. I know that MO does a lot of investor awareness initiatives. I just wanted to understand, what are the current challenges that you're seeing? You have been kind of creating this awareness for a very long time. There is an active bias in the Indian markets, and even in that space, there is also a lot more that needs to be done. So, given that one needs to now, include both active and passive as a part of their portfolio, what do you think are going to be the biggest challenges from an investor perspective? And what can the industry and the players like manufacturers and facilitators in the market do to ease out the process so that more and more people understand the options that they have so that they can make the right choices?
Yeah. Yeah. So I think, when it comes to, mutual fund investing, I think, well, there's 2 points. One is about investing, and the other one is, active and passive. I think in terms of the passive, piece, I really think that the sort of awareness that the industry's already done, over the last 3-4 years have been quite credible. I think if you look at the awareness of passive funds, I think 2019, I used to explain people how an index fund worked, how an ETF works. Today, I think the conversations are way beyond that. Even someone who does not invest in equity, who has 100% FD portfolio, does actually know what an index is or what an index fund ETF is. So I think the industry has done extremely well in terms of getting this communication outside. I think social media, internet has also made it easier for people to access and see what passive funds are about. Also, I think a lot of these online digital platforms, that have really garnered so many customers over the last 4-5 years, have done a great job of talking about these products with their customers. So overall, I think, I would, expect the industry to do the same going forward. I would probably push more and more AMCs to talk about it. I think a lot of AMCs have passive funds, but they don't talk about it. I think that my sincere sort of recommendation would be that having a product is not honestly enough. You have to talk about it. People need to trust you. There are a lot of trustworthy brands already in the marketplace with similar products. So I think it really is important for investors to, for AMCs or even distributors or partners to talk about these things a lot more, and which we have seen started, but it's not really reached a pace in which it should be. So I think investor education awareness is something that will hopefully happen a lot more in the future as more and more fund houses, more and more funds come. The second is I do agree there's a lot of confusion in the marketplace. So I think what has worked for us, maybe our experience of keeping it simple in terms of I think the products is really helps investors in terms of making that decision about which fund to buy, which fund to sell. So I think simple marketing, being focused on the simple products, the broad-based products, is worked really well for mass adoption of passives. And third is that I think one reason, one area where I think the industry hasn't really focused much on is really investor education, not about products, about categories, but about behavior. I think one of the biggest I think for reasons to why investors don't create wealth, it's not because they've invested into a bad product or a bad fund. They've lost wealth or they haven't created enough wealth is because they've got their behavior wrong. I think it doesn't matter if you buy an active fund or a passive fund, or if you buy both. If your behavior is not there, what we've seen is the behavior gap is quite large. The index delivers about 12%. An average investor in India makes about 6 to 7%. So it doesn't really matter if you buy any fund. All funds will be more than 6 to 7% over the long term. So I think the more investor education on behavior is going to be a lot more important going forward if we want more and more equity investors coming in, to India. So I think that I think is one aspect where I would really, in addition to obviously category awareness of passive, will really help our investor base create wealth.
That's really good advice, Prateek. I think that is behavior is something that always is driving investor to whether they want to take an action or they don't want to take an action. And obviously, passive and active is been a debate for a very long time. We are now trying to merge the lines and trying to create a cohesive conversation. Even now, we see it a challenge to have these conversations. It's rather it's not only a push strategy in terms of people buying the product, but a push strategy in terms of even people listening to these such conversations. But when they do listen to it, they do realize the value, and then they get a lot of clarity in terms of how they can make their choices. Now, I would just request whoever out there in the audience, if you have questions, we have time to take maybe 1 or 2 questions. So please do post your questions, and we'll try to take this up before we are out of time. But as a last kind of summary kind of thing, Aman, let's just talk on a holistic perspective of the passive landscape, right? And the active landscape both, because today we are talking about how the active and the passive can synergize, and investors can take the benefit of the two. So I know you're no fortune teller, but you have been in the market, been there, watching the winds of change shift in both spaces. How do you see that this space will grow out maybe in the next few years? And well, while the market did, if you look at the passive market, it's taken us almost a decade to nearly reach $1 trillion. We are at around $90+ billion of worth of assets under management, with a lot of kind of institutional flow. But if I would sense that we won't take another decade to build out the next trillion. But again, from the active space as well today, there are assets which have swelled up, SIPs are growing, but again, there is a lot to be, there's a lot more that people are asking for. So what is your viewpoint in terms of both these markets growing out, and how investors will then start, basically capitalizing from the growth of both of them?
Sure. Pertinent question. The unfortunate part of this debate of active versus passive is that we miss both. As Pratik rightly mentioned, it's all behavioral. It's not the market, it's us. It doesn't really matter, whether it's active or passive. What matters is at least to be there. You invest in the equity market first. Because if you're there, if you've invested, at least you've got some part of the beta return. Forget the alpha for the moment. For passive to really grow, passive doesn't really need to eat into active's share. Simple back of the envelope calculation says that 46 trillion worth of managed asset size today, 70% is passive, around 7.5 trillion debt and equity put together. I'm not counting gold and silver in this. Even if the industry, the MF industry, has to maybe reach 100 trillion in the next 5 years, and if the passive share converges to global average partially, not even completely, from 17% to maybe even 20%, we are at 20 trillion in the next 5 years if the industry has to move to 100 trillion, at the least, because at least if we just maybe extend the current trend and extrapolate that, it may move to maybe anywhere between 20 to 25% market share. And if that happens, on a base case scenario, the asset size for passive should be around between 20 to 25 trillion. And this is no rocket science. This is just back of the envelope calculation. But again, even as someone who's passionate about passive, even as an index provider, I would not want passive to be the only option. And that's not healthy also. And there are a couple of reasons for that. Active and passive need to coexist. But in 1970s, Eugene Fama has done a lot of work around this, where he's defined the concept of efficient market hypothesis, which says that the market is efficient, and there's nothing that that others don't know, and you can't beat the benchmark consistently and repeatedly, because everything that is already factored into the price of the stock. Now, this is what he says. But what he also says that you need some set of people to keep the market efficient. So, you need the active guys for you to really factor in any news, good or bad, into the stock price. Passives don't do that. It's the active guys who really react on news, good or bad, react on fundamental discrepancies in a company, react to strength of balance sheets and P&Ls, react to business edge, and factor that into the stock prices. So it's really the active guys, and I'm just trying to make a balanced view here. It's really the active guys who would do that. So a healthy balance of active and passive is required, because if the active guys are not really keeping the market informationally efficient, which is the premise of passive investment, that market is efficient, and that's why you can't beat the benchmark, but you need a prerequisite for that, which is the active guys. So for that real reason, for that traditional reason of coexistence, I believe that the pie will increase, and as per general predictions, 100 trillion in the next 5 years, maybe. Passive will definitely increase from a worst case scenario or a bad case scenario to 17 trillion to a good case scenario, or a healthy scenario to maybe 25 to 30 trillion. And both will exist at the same point in time, and everyone's portfolio would have a good mix of active and passive, and that's how it should be. The core satellite approach we've all read about, we've all been following that, needs to be followed, and everyone does not need to buy every index strategy. Pratik rightly mentioned that you need to keep it simple, keep your portfolio as simple as possible. Even if we are literate enough to understand complex index strategies, we would want to keep our investments simple, because our life otherwise is already complex. So we would at least want to keep our investment portfolio simpler. Yeah. So, but again, on a lighter note, between active and passive, hum hi hum hai to kya hum hai, tum hi tum ho to kya tum ho. So, coexistence is important.
Yeah, that's very well said and very well concluded. And I think we have a little bit of a shy attendees. So attendees, please do put in your questions. I hope the explanations are simple enough for you to understand, and there is no good or bad questions. So go fire away, and we have a very very expert panel out here who can answer. But I think we'll just have one question currently, which we can pick up, and Prateek, definitely something that you can maybe pick up is for a new investor, what should they first pick up, rather. It says, is it active or passive?
Um, normally what happens is the new investors tend to stick towards stocks, and then they sort of a lot of them end up, well, a good proportion of them don't end up not doing very well with stocks, and then they move towards mutual funds. So I would say a new investor, instead of dabbling with stocks, buy an ETF. Start with an ETF. That's a great way of starting your investment journey. I think one of the biggest I would say uh, not philosophies, but like frameworks for investing, at least according to me, is that every new investor is very excited, is very optimistic, is very, I think there's this really sort of big amount of, confidence that new investors have. If you look at all the investors who made a lot of wealth, they're actually quite, humble and, so I think what I would say is that, if you're looking at investing for the first time, there will be this tendency of you to really take, high risk, big shots, all of that. What I would expect is to, do that. Don't stop doing that, but do it with a small amount of capital. What we tell all our investors is that, if you're looking at, say, putting in 1 lakh or 10 lakh rupees into the stock market, mutual funds, then maybe 8 to 9 lakh, put it in very simple, flexi cap, multi cap, Nifty 500, Nifty 50 sort of, funds, which will compound at a very good rate. And then maybe what you can do is, if you have, a certain appetite to take more risk, as humans, unfortunately, we cannot stop ourselves. We have strong urges, especially to speculate. We love speculating. So I think do it with a small amount, do it with about 10-15% of your portfolio. And yes, if you do well, you can expand that. What normally happens is people put 100 into, stocks, or, some very thematic index, or a very small cap, something like that, which is very high risk, high return. And that's a very bad strategy, because over time you'll see that not many people create wealth on small cap indices. They do it with large cap indices and all of that. So I think 90% should be on simple stuff, and then 10% or 15% you can go out there and do whatever you want. So I think that's the framework that I would use for someone who's starting up new.
Follow-up question from my end, Pratik, to that. What is then the ideal balance, if somebody is creating an entire portfolio with active and passive balance? Because both active and passive have their share of large cap strategies, their share of, thing. But there are some strategies which are there in the passive space, which is not there in the active space. Is that then the way you balance out your strategy between active and passive, so that you add those strategies which are not there in active as a passive strategy, or how does it work?
Honestly, there's no really right way. I think it really depends on people's willingness to learn. If you are a type of person that does not want to spend any time thinking about a portfolio, then 100% passive is also perfectly fine to do well. Probably as good as what you would do if you had a combination. So I think 100% passive is perfectly fine. I think if you have the ability to spend more time, understand, maybe pick a fund manager, then maybe a combination works really well. As I said, I think look at passive as a way in which you can really invest for a very long time, not able to sell for long periods, say 5, 10, 15, 20 years. And then active is somewhere where you can look at, okay, I'm looking at next 3 to 5 years time. Where do I see value? Where do I see, who, maybe there's some fund manager who's, has a very good long track record, and, maybe I'll bet on him or her for the next 3 to 5 years time. I think the one thing that investors should not do is invest based on past returns. Very bad. Most people do it, unfortunately. But if you're looking at an active strategy or a passive strategy, don't look at it looking at the past 3-year returns, 5-year returns. I think the return should be is important, but not the most important. I think the credibility of the fund manager, his or her ability to really follow a certain philosophy and sort of do the right things is a lot more important. So I think don't look at returns, very important. And if you have the capability to go out there and find good managers, then yes, you should do a combination. But also, to be honest, for a lot of people, if they don't have the time, then 100% passive is also perfectly fine.
Great. Thanks, Prateek. And I think that comes to the end of this ETF Pathshaala session. I think we had a really insightful discussion from getting to hear from both Prateek, Aman, and Saket, an understanding of how both active and passive can go to form a very well balanced portfolio. The kind of options that have, I think Aman really give you an entire spread of what are the kind of options that are available, a deep dive into the kind of smart beta products that are there. Prateek has spoken about, don't only focus on returns, and there is a possibility that you can go all passive. So there are options out there. And of course, Saket also spoke about all the tools that are there and the investor awareness that one should do to continuously keep enhancing the knowledge set. So with the intention of keeping on growing this investor awareness, we will continue the ETF Pathshaala series next week as well. But a deep thank you to both Prateek, Aman, and of course, Saket to be here and share all your insights. I'm sure it was very, very valuable to the attendees. Thank you so much.
Thank you for having me. All the best.
Yeah,
Thank you.
thanks.
Bye.
Thank you.
Thanks for having me too. Thank you.
Thanks.